Hi, everyone. I'm Mani, the founder and CEO of Valur. The Qualified Small Business Stock Exemption, or QSBS, is the most critical tax benefit for many small business owners, startup founders, investors, and employees. QSBS allows qualified owners to eliminate up to 100% of their federal income and state income tax. In our QSBS overview video linked below, we cover the basics of what the QSBS exemption is, how it can enable you to avoid taxes on up to $10 million of capital gains per individual per asset, and how to qualify. In this video, we'll explain how with a QSBS stacking strategy, you can avoid taxes on 20 million, 50 million, or more of QSBS qualified assets. So let's start with the basics. How QSBS stacking works. The QSBS exemptions requirements are fairly straightforward. Every person or qualified trust who owns qualifying shares gets to pay 0% in federal taxes and potentially 0% in state taxes everywhere except for California, Pennsylvania, and a few other states on their first $10 million of capital gains. The key to QSBS stacking is right there in the requirements. There's a new $10 million exemption for every person who owns qualified stock. In other words, if two people each own qualifying shares, they both get a $10 million exemption, or $20 million between the two of them. So how can you take advantage of these rules? By giving some of your qualifying shares to a qualified trust or someone else, the recipient of those shares will be allowed their own exemption, enabling you to increase the amount of exemptions from your shares, effectively uncapping the QSBS exemption, the amount of gains that are tax-free. What's more, if you give qualifying shares to a trust or a person, they get to inherit your eligibility. This means if the shares were eligible for the exemption when you receive them, the recipient of your gift will also have eligible shares. In addition, the recipient gets to take over your eligibility clock and keep it going. Just as a quick reminder, you have to hold QSBS qualified shares for at least 5 years to get the exemption. And if your shares have hit that point, so will your recipients. And if you've held it for 4 years, that clock will keep on going from that point. Now, with the definition in mind, founders, employees, and investors with large stakes in qualifying companies need to consider the following strategies to multiply their QSBS exemptions and avoid taxes above $10 million. The first, it's an outright gift. A simple gift of shares to your child, parent, or another individual is probably the simplest way to take advantage of additional QSBS exemptions. If you give your qualifying shares away, the recipient can pay no taxes on their first $10 million of gains, enabling another QSBS exemption. The second option is a gift to a trust. This is the second most straightforward. If you'd rather not give your shares away outright to someone, you can put them in the shares in a qualified trust. And based on the trust you choose, anyone from you, your spouse, your kids, unborn children, or future generations can benefit from those proceeds and that QSBS exemption. I know that sounds like a lot, but let's walk through an example of QSBS stacking to illustrate the benefits. Take a New York founder, Jen, who owns and plans to sell all of her $25 million of equity following her company's IPO. Jen early exercised all of her shares, and her cost basis is about $100. Jen currently has one son, and she and her husband plan to have another kid in the next couple of years. Without the QSBS exemption, Jen would have to pay taxes on the full $25 million of gains. So she'd owe about $8.5 million in federal, state, and local taxes. Now, with her own QSBS exemption, Jen can pay zero taxes on the first $10 million of gains. That's the straightforward and baseline assumption. If she doesn't do anything else, she'll owe taxes on the remaining $15 million. Now, one option for the remaining $15 million, if Jen wants to extend the tax-free treatment on those remaining gains, is possible if Jen is okay giving up some control and access to those funds. There are other options where she wouldn't have to do that. Jen decides to set up 2 non-grantor trusts for her son and one for her unborn kid. They're each beneficiaries of these trusts. And then she gifts $7.5 million of equity to each trust. And after the company's IPO, the trusts sell the equity, realize the gains, and are each able to claim their own additional QSBS exemption and as a result, avoid taxes. As a result of this simple planning, Jen's family will collectively pay $0 in taxes on an entire $25 million stake. Understanding QSBS stacking can enable life-changing savings. Now, if you have any questions or want to see your potential savings, you can check out our in-depth guide on QSBS stacking, and use our easy-to-use tax saving calculator, or chat with our team if you have any questions. Now, a quick word about Valur. We've built a platform to give everyone access to the tax planning tools of billionaires like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at Valur, valur.io, where you can read more content on these subjects, play with our online calculator to discover your potential financial gains, or schedule a call with us.